Hello, this is Richard Pearce from Finextra TV, and I'm delighted to be joined today by David Harris. David, hello.
Richard, thank you for having me.
You're with London Stock Exchange, of course, and you're the head of sustainable finance there. And we've had some interactions going back a while now, I suppose. But please tell our audience a bit about you and a bit about your role there at London Stock Exchange.
Well, thanks. Well, originally I joined FTSE. That was a number of years ago now, and then the group has grown. We became fully part of London Stock Exchange Group, and I work on making sure that we're integrating sustainable investment and finance really across the capabilities across the group. So I work particularly on the FTSE Russell side, but also with my colleagues on London Stock Exchange, Borsa Italiana, and really think about this flow of sustainable investment data across the market, across from issuers through to investors, and the capabilities that we need to have to support both really the entire market.
And so you've been there since 2002, is it, something like that? Tell us what's kind of changed over that period of time briefly, and then we'll start to look forward.
Yeah, well, so I've been working in this field now for over 20 years. Initially, I was working in sustainability consulting firms, helping companies understand this. Mm-hmm. And that was around the time FTSE for Good was being launched. And FTSE realised they needed some people to help them on sustainability issues. The term environmental, social and governance, ESG, hadn't been coined then. No. And so I joined in 2002. And back then, there was very little, actually, investor interest, particularly institutional investors. Pension funds wouldn't take meetings to talk about this.
Really?
It was much more kind of ethical retail funds. And what we did find, and partly why they needed me to join, was that actually the media was having a field day. The Daily Telegraph called it the silly index.
Really? Oh my goodness me.
We had companies who were really upset that they hadn't been included, so by RBS and Tesco. Also we had NGOs like Greenpeace who were really upset that certain companies had been included. So originally a lot of it was about making sure people understood the methodology, making sure we were based on very kind of clear criteria that everybody could understand, and making it clear also that this was about good practice and that the thresholds would raise over time and companies needed to keep pace with that. Mm-hmm. If we fast forward to today, obviously the market has changed completely, and now this is actually the highest priority issue for most of our largest investor clients.
Absolutely incredible, isn't it? And so tell us what you're most excited about today. There's so much going on, but give us through your eyes, the things that really excite you.
Well, thinking about back then. We were having a lot of effect through engaging companies, and companies were desperate to be included in FTSE for Good, but the AUM behind these kinds of indexes was very small. What we've seen more recently has been increasingly a lot of funds, initially or pension funds, focusing on their active portfolios, then moving on to think about how to integrate ESG and climate risk in particular into their passive portfolios. Now, originally that was about voting and engagement. Increasingly now that's about bringing it into the index design. So there's more and more large funds bringing climate risk in particular into the design of those indexes, and we overweight, underweight companies on a lot of their climate credentials and position. Mm-hmm. But I think many companies are just unaware of the level of change that's going on in the investment industry and how many very large funds are making these changes. So, you asked about what interests me, what excites me.
That's right.
And I think that is the fact that kind of original kind of engagement there's a way through for these kinds of indexes. And there's an initiative called TPI, the Transition Pathway Initiative, set up by a range of different pension funds. London School of Economics is a partner, provides the kind of academic interlink into it. Mm-hmm. We provide data into it, but it's got a steering group of asset owners and some asset managers. And the idea is to come up with very transparent criteria, which is a basis for investors globally to use to engage companies in high carbon sectors. So they get it put on a staircase, very simple, 0 to 4, mm-hmm. all based on TCFD, so the Task Force for Climate Related Financial Disclosure mm-hmm. data points, from 0 up to 4. And the idea is that all the investors are engaging the companies effectively, collaboratively, encouraging them to make the changes to go up the staircase. So that might be about setting better targets, that might be about linking it into executive remuneration, and they're collaboratively engaging. Now,
Yeah, please do carry on. So, and particularly on this TCFD thing, I'm interested in. So carry on.
Yeah. So the idea here is how can we put that data though into the index, so that then for passive index investors that they can then align their index investing with their engagements. So, and Church of England's been a real leader on this.
Yeah, absolutely. Yeah.
And they and the Environment Agency co-chair the TPI. But the Church of England Pension Fund has now moved its developed markets equity assets into an index which overweights and underweights companies based on TPI. So as they engage companies, they're able to say, look, if you do these things, if you step up, then the investments will follow.
And we have to ask the question because, you know, it's always people are concerned with the term greenwashing and, you know, where the data come from that authenticates, you know, all of this that therefore drives the indexes. What's your feeling on where we are today with that and with the quality of data, which is, you know, quite often seen as the weak point in the overall industry? But that narrative's been around for a while. Where are we up to now, do you think?
Well, there's really kind of two core types of data. You've got data that is reported by companies, and you've got other kind of less structured data from a whole variety of sources, whether it's from regulators, whether it's from social media, whether it's from satellite data. And it's how can you make sense and make use of these range of data types. In terms of the corporate reported data, it's as it gets more kind of independently verified, becomes very important. And also where they publish it. So, for example, publishing it in the annual report is probably, you know, more credible than in a CSR report, and that's more credible than actually only providing information through a private survey. So the credibility of data is improving over time. The availability of data is getting better over time. When we think about that kind of unstructured data and this kind of big data, there's a lot of excitement there, but there's also often not very much transparency really about where the data is coming from, how to understand it, and really how to apply it in a sensible way.
So for you, that's a sort of it's one of the things we've been talking about is it's an exciting future about how you can bring that data together, analyse it and get signals from it, but it's still at the early sort of foothills of that at the moment for you.
That's right. Well, I think, you know, both these areas are evolving very quickly. They play an important part in the data that feeds into our indexes. Yeah. But I think it's still very early days, particularly on how to make sense and make sure you've got the transparency around a lot of that unstructured data.
Absolutely. And so when we think about on the data side, and you spoke earlier on, but, you know, EU taxonomy obviously has just you know, been published, and I know you were involved in the stages prior to the TEG. What's your feeling about that? Is that going to be a good thing for us? Is that going to help the industry?
Absolutely. So we are a huge advocate of this, and I was, as you say, part of this group, HLEG, which precursed the TEG, and we produced a range of recommendations for the EU, which shaped the Sustainable Finance Action Plan. Recommendation number 1 was the taxonomy.
Right.
And the reason why I thought that was so important was we've been doing a lot of work on green industrial classification systems. The first one we launched was in 2008, fed into and supported certain indexes like the FTSE Environmental Market Series. But also we wanted to start to provide the underlying data through to investors, and we could see that was more important. That was very important as well. But many companies don't, again, provide the right data. So they don't break out their segments. So an example might be a lighting company. It provides information on its, you know, lighting is one of its things it manufactures. You get revenue on its lighting segments, but you don't know how much comes from LED lights. So what we need is better sub-segmental revenue breakdowns. That then feeds into a whole host of different investor uses. And it's really important to be clear that lots of very large investors are trying to increase their investment allocation to green industries. This is, you know, it's in the company's interests to provide this information to the marketplace.
Yes. There's a lot of allocation, not necessarily the sort of the drawdown and the actual investment at the moment. So we've got to sort of speed those elements up. As you head into, you know, COP26 in Glasgow, what's your sort of feeling about what you guys are going to be doing, what the industry should be doing to make sure that is impactful?
So COP26 is quite big for us. This is 5 years on from Paris. This is hopefully a time when we're going to get a really meaningful agreement and enhancements to what was agreed in Paris to deliver what we really need to get to hit 2 degrees. At the moment, if you add up the Paris pledges, you don't get to 2. Now for us also, we are, with London Stock Exchange, Borsa Italiana, and given that this is a co-presidency between Italy and the UK, we think we've got a big role to play here in making sure that the finance sector and the business sector are really plugged into COP26. And actually, we're never going to achieve those kinds of carbon emission reductions without business and finance really helping to drive that. I think in terms of, and I think also with FTSE Russell working with investors as well as the exchange sites and issuers, that's a very powerful way to kind of bring the market together. There are 3 things which we're really interested in here. One is around the data. Obviously, to power these kinds of indexes, we need good data. And TCFD is a great starting point. We've got a clear global agreement. It's a danger of different regulators and different markets come up with different standards. So how can we get better, more consistent data globally? And we've got an important role to play there. Second part is how do we get more investment into green industries? And I think as we talked about, the taxonomy actually is very important there. We're also using our version of that, the green revenue system, to be able to provide a green economy mark. So for any company that's listed in London Stock Exchange, which has got over half of its revenues from green industries, gets the green economy mark. And this is actually a big focus for a lot of investors, as I mentioned. So it's also very attractive for investors. For companies. So we had one of the biggest IPO of the year, Callison, smart meter company. Yeah. Part of its pre-IPO effort was the fact that it was getting the green economy mark. Fantastic. So green economy, but thirdly, the third thing is helping high carbon sectors transition.
Yes, absolutely.
Which links back to TPI, which we talked about earlier.
Yeah. The final thing that I'd like to discuss with you, again, we could talk forever, but it's, when you look at the passive versus active was the kind of polarity discussion, yes. Wasn't it? And, people talk about, well, all of these carbon industries can delist and head off to a sort of, a different world of private equity and active investment. What's going on in that world at the moment from your point of view? Where does that polarity, does it remain like that, or is it actually, things are blurring?
Well, for many years I've been saying that that active investment is really where the kind of core sustainable investing is, and passive is really restricted to voting and engagements. And that world has completely changed. Now, bringing ESG and climate into index funds is becoming increasingly commonplace amongst big pension funds. And so that change, that means that you can potentially have very powerful engagement. So as you link this into index design, and as companies understand the rules of what determines index inclusion or the weight of their company in the index, that becomes a very powerful lever for engagement. So the biggest investor in the world, GPIF, Japan, the government pension fund, $1.4 trillion in assets. Their view is that they are a universal investor. They're invested effectively across the whole economy. And their interests are super long term. They talk about themselves as being an intra-generational investor. And their investment belief is that the whole economy will perform better with higher sustainability standards. And so they are wanting to incorporate sustainability into the design of their index funds because that incentivizes companies to improve their practices. Yeah. So it's about some really interesting ideas about universal investors and how to link it in.
An amazing point probably for us to come to a conclusion, because it sort of takes us on that total journey from when you said nobody was interested to that kind of extraordinary example. We'll come back to this again, I think. David, thanks so much for your time today.
Richard, thank you.